Hello, and welcome to the Wave 2 entry training series on Elliot Wave Theory. Here you will learn everything you need to know about it and how to understand chart patterns and gain an advantage over other traders by putting the probabilities in your favor. In this episode 1, we are looking at the impulse wave. The impulse wave is a 5-wave structure which you can see on the chart. It can go 5 waves up or it could go 5 waves down. And the simplest way to think about the impulse wave is to think of the trend, because that is literally what we're talking about. The trend up or the trend down that we can see on the chart in the market. We start at a low, we finish at a high. We start at a high, we finish to the low. That's the easiest way to think of an impulse wave. You are just simply observing the trend and trying to follow it. There are, however, a series of rules which must be obeyed when identifying an impulse wave. Wave 2 cannot retrace wave 1. This is rule number 1. That means that this wave here cannot extend beyond the start of wave 1. Rule number 2. Wave 4 cannot retrace the top of wave 1 unless it is a diagonal. Now we will cover leading and ending diagonal patterns in our alternative motive waves in a future video. But for the moment, we're focusing purely on the impulse wave, and this rule is strict. Wave 4 cannot retrace the top of wave 1. Our further and final rule is wave 3 cannot be the shortest wave. Wave 3 in itself can be shorter than wave 1. Wave 3 itself can also be shorter than wave 5. But wave 3 cannot be shorter than both wave 1 and wave 5, the other two motive waves in our impulse wave. Now that we've discussed our rules and have established them, let's talk about the subwave structure of each of these waves. There are 3 motive waves, each made up of 5 subwaves, and there are 2 corrective waves, wave 2 and wave 4, each made of 3 corrective waves. Let me show you what I mean. Each motive wave is itself made of 5 lesser waves. This will be the wave 1, the wave 3, and the wave 5. Each corrective wave, the wave 2 and the wave 4, will be made of 3 subwaves. These will be labeled differently from our motive waves, which are labeled using numbers. Our corrective waves are labeled using letters. Now you may have noticed that the numbers on the impulse wave that we're looking at are circled 1, 2, 3, 4, 5. But the numbers in our subwave are bracketed 1, 2, 3, 4, 5. This is to help you identify waves of greater and lesser degree. A subwave here is the intermediate wave, 1, 2, 3, 4, 5 in this bracketed form. The wave 1, 2, 3, 4, 5 in its circle form is the primary wave, and there are a multitude of waves above this level and below this level. Above this level we move to the cycle wave, the supercycle wave above that. Below this level we move to the intermediate wave, the minor wave, then the minute wave and the minuet wave. The same is true of the corrective patterns. The A, B, Cs are also built of subwaves themselves, which are of lesser and greater degrees, depending on the overall structure you're observing. So let's just hide these where they were. So we've covered our rules, we've covered our subwaves, which can be expressed very easily for an impulse wave as 5, 3, 5, 3, 5. And that's it. Now that we've established that, we need to establish how to find our waves when looking for them and where they are likely to complete. But we can do that using a series of Fibonacci relationships. So the first thing we're going to need to do if we're using TradingView is go to the left-hand menu, scroll down a few selections, open the tab, and halfway down you will find the Fib Retracement and Trend-Based Extension tool. Now I favorite both of these, so I can have them in my bar, my favorites bar, at the top of any chart, which I can move around at will. So the first tool we're going to be using is a Fib Retracement tool. So let's zoom in a bit and see where this wave 2 retraced to. Unsurprisingly, since I put it there, it retraced to the 61.8%, which is the target we're looking for. Now although this is the target we're looking for and has the greatest probability of the wave 2 completing in this region, it doesn't have to complete here. However, as a guideline, we would expect to see it at least reach 50% of the prior wave 1. It could go to the 61.8% where we expect to see it, but it could go to 65%. Now, this is often the case of what I would call an overrun or a bit of slippage in the price. We were essentially aiming for the 61.8% and went a little deeper beyond this. There are other Fibonacci targets. Now I have several other targets on my Fib Retracement tool that I personally use, but you will standardly just have the 61.8%, the 78.6%, the 100%, the 38.2%, and the 23.6%. Now if you go past the 61.8%, your next target is likely the 78.6%. But because of our rule, remember that we are observing that wave 2 cannot retrace wave 1. The other side of that rule is wave 2 can retrace as deeply as wave 1. If we just find our wave 1 for the moment, we can move down there just shy. As long as we don't go past wave 1, we're still legal. We can come down to 0.00001%. It's 99.999% and still be legal of a retracement of wave 1. This is very rare, but it can happen. Our most likely target, though, is going to be the 61.8%. So that's what we're going to be looking for most of the time for a wave 2 retracement. Zoom back out now. Our next guideline, we have to find our wave 3. We found wave 2 where our wave 2 should be. So now we've got to find where our wave 3 should be. Our wave 3 is typically 161.8% the length of wave 1. Now we're going to need the different tool here. Now we're going to need our fib extension tool. We're going to click at the bottom of our impulse wave, come up to the top of our wave 1, and then move the zero bound, which is the white line, down to the bottom or the start of wave 3. We're looking for the 161.8% extension of wave 1, and here it is. Okay, so moving on. We're most likely going to find it at the 1.618, but it can stop at the 1.318. Now, I often use the 1.318 when I'm looking at a very long and very big wave pattern over a long time period. I will often use the 1.318 in log scale and the 1.618 to see where I could locate a wave 3. Now, in pure price terms, we should be seeing it at the 1.618. If we go beyond the 1.618, the next likely targets are the 2.618, the 3.68, and the 4.236. This would be a very overextended wave 3, but it can happen. However, if we don't make the 1.618, then we could go lower at the 1.318 or below that. We could be at the 100% extension of wave 1, or potentially we could be shorter than wave 1. Although we are likely looking at a different kind of motive wave at that point, it is still a possibility. The only rule which becomes relevant at this point is the area we have available to us in which the wave 4 must complete. From here, the wave 4 must still finish above the wave 1 in order for this to be a normal impulse wave. At that point, the wave 3, although shorter than the wave 1, must still not be the shortest wave of the 3, which means the wave 5 is going to be very short because it can't extend beyond the wave 3. Although the symmetry is disgusting to look at for someone who likes to see nicely measured waves, it is still a legitimate impulse wave. If 3 is not the shortest, the 4 doesn't overlap the 1, and the 2 doesn't overlap the start of the impulse wave, but the symmetry is not very pleasing to the eye, and it would be a very rare occurrence to see that happen, but it can happen. So just bear that in mind. We're looking for a 1.618, but if the 3 is shorter than the 1 or only slightly longer than the 1, then this will impact where the 5 can go. Let's move on. Wave 4 is typically 38.2% of wave 3, so we're going to need our fib retracement tool. We've come to the start of our wave 3, to the top of our wave 3, and see where our wave 4 retraced. It retraced to 38.2%. This is where we would expect to see it. Wave 4, however, can retrace shallower to 23.6%, which is the next most likely fib level target for the 4 after the 38.2%. The next most likely target for the 4 is the 50% retracement. However, to see a wave 4 go beyond this is quite rare, and at that point will be most directly related to an asymmetry between the wave 2 and the wave 4, depending upon the market you are observing. Now, this is not a guideline or a strict rule. It is simply an observation. I have observed trading commodities and other markets. In other markets and in the commodity market, it is quite common. If you see a very, very deep wave 2 that's drawn out over a very long time, you will see a very shallow and quick wave 4 in terms of time frame. Also, I found that if you find a very shallow and drawn out wave 2, you could have a very quick and sudden wave 4. These kinds of asymmetries don't tend to appear very frequently in equities markets, but they can appear quite often, not more often, but quite often in commodities markets such as oil, natural gas, copper, gold, silver, and so forth. But since we're following the basic rules at the moment and basic guidelines, we're going to continue to use our targets over here. I'm just showing you for flexibility. As long as these rules remain intact, there's still quite a bit of movement you can play with. Now, having established the wave 4, we now enter the wave 5. The wave 5, for whatever reason, seems to have the greatest potential for variance. Now let's talk a little bit about why. When we're looking at the trend as an Elliott wave, as an impulse wave, what exactly are we looking at? We are looking at market psychology. That is literally what the Elliott wave is. Wave 1 is often the shorter of the main motive waves. Why is that? We've come off of a low, and the bulls are not particularly strong, and there isn't much confidence in this asset. Wave 2 is a deep retracement, typically of the wave 1, because the bears are still significantly stronger or are stronger than they will be later in the trend. They have enough power and enough influence to deeply correct the price, and the bulls are unsure enough and weak enough in their holding to allow this to happen. So the psychology of the wave 1 and the wave 2 is very much a time where the market is in a state of balance, and that is why the wave 2 can be quite deep. Now wave 3 is when most of the institutions that are going to be on board are by now, and this is why the wave 3 can often be the longest wave. It doesn't have to be the longest, but it often is the longest. Institutional interest is peaking during wave 3. The bulls are getting stronger, which explains why the next wave in our wave up in the market is the wave 4. And this is only a 38% retracement, as opposed to a 61% or 78% retracement. The bulls are stronger, but the bears are weaker at this point. Now, by the time we get to wave 5, this is when everyone and their cat is buying the stock, and this is where the FOMO traders arrive, the fear of missing out, and the retail investors arrive. You could call this anything. You could call this your Bitcoin wave or your Tesla or Nvidia. However, this wave is subject to all sorts of variations, because depending on the relationship of wave 1 to wave 3 and whether or not it is the shortest wave will restrict how long wave 5 can be. If wave 3 has already fulfilled the rule of not being the shortest wave, it allows wave 5 to go into an extreme extension in some cases, but it doesn't have to. For example, let me explain. Wave 5 is typically 61.8% of the total motive wave from the start to the top of wave 3. So what does that mean? Start at the bottom, bypass wave 1 and 2, go straight to wave 3, and then project the length of wave 1 and 3 from 4, and we should see a wave 5 which finishes at 61.8%. This is the most likely place to find your wave 5, the most typical place, but it is by no means a certainty. It's not as sure as the 61.8% or 38.2% retracements of waves 2 and 4 respectively, or the extension of wave 3. It is the typical place to find it, but is less certain. If we're not using that, we can use other wave 5 targets. Our extensions of wave 1 projected from wave 4. These are 61.8%, 100%, and 161.8% or higher. Let's look at that. Take our wave 1, project our wave 1 from wave 4. So all I've done is come up, click the bottom of wave 1, click the top of wave 1, and move the zero bound to the wave 4. Let's look at our first target, 61.8%. The 61.8% results in what we call a double top. Although the FOMO wave can be extreme, you have to understand that the institutions that have gotten in are happy to get out at the top of wave 3, and anything they're making in wave 5 is gravy. Market sentiment can shift quickly between wave 4 and wave 5. There could be bad news about the stock, there could be a factory burning down, there could be a global pandemic, who knows? Either way, the institutional strength behind wave 5 is not there. We're talking FOMO investors and retail traders, and they are far more subject to market psychology. So it's possible for wave 5 to finish earlier, to finish at the top of wave 3 as a 61.8% extension of wave 1. It is also possible for it to have something called a truncated 5, where the wave 5 makes it only 50% of this move and actually doesn't go beyond the wave 3 at all. Now we haven't broken any rules. Wave 4 hasn't gone below the top of wave 1, wave 2 hasn't gone below the start of the impulse wave, and wave 3 is still not the shortest wave. This is a rare but possible Elliot wave pattern of an impulse wave where the 5 completes below the 3. However, let's assume that after the wave 4 correction is over, market sentiment becomes more and more bullish. This can result in bubble behavior and people becoming extreme in their optimism and belief in the stock. This is why it's often called the FOMO wave or the Eliiot wave. Let's dive deeper into some more advanced aspects of the impulse wave. Now that we've covered the basic rules and guidelines for identifying and counting an impulse wave, we need to consider the common pitfalls and mistakes traders often make. One common mistake is misidentifying corrective waves as motive waves and vice versa. It's crucial to remember that corrective waves, which are wave 2 and wave 4 in an impulse wave structure, typically form in 3-wave patterns labeled A, B, and C, or in more complex forms like W, X, Y. Corrective waves can sometimes be tricky because they can take various forms such as zigzags, flats, and triangles. Understanding these forms will help in correctly identifying wave counts. Another point to note is the importance of wave alternation. This guideline suggests that if wave 2 is a sharp correction, wave 4 will typically be a flat correction, and vice versa. This alternation provides a balance in the wave structure and helps to predict the nature of future waves. In addition to the rules and guidelines we've discussed, Fibonacci relationships play a crucial role in Elliott wave theory. These ratios help to forecast the lengths of waves and identify potential reversal points. While we've touched on the use of Fibonacci retracements and extensions, it's important to master these tools to enhance accuracy in wave counting. For example, the golden ratio, or 61.8%, often appears in wave structures and serves as a key level for potential retracements and extensions. Let's move on to some practical tips for applying Elliott wave theory to your trading. Firstly, always start your analysis from a higher time frame to get a clear picture of the primary trend and wave structure. Once you have a broad understanding, you can then zoom into lower time frames to refine your wave counts and identify entry and exit points. Secondly, use a combination of technical analysis tools to confirm your wave counts. For instance, moving averages, trend lines, and oscillators can provide additional confirmation of wave patterns. For example, if you're unsure whether a wave 2 correction is complete, look for confluence with moving averages or support resistance levels and divergence in momentum indicators. It's also crucial to stay flexible with your wave counts. The market can be unpredictable, and wave patterns may not always unfold as expected. Be prepared to adjust your wave counts as new price data becomes available. This adaptability will help you stay on the right side of the market and avoid costly mistakes. Moreover, practice is key to mastering Elliott wave theory. The more you apply these principles to real charts, the more proficient you will become. Backtesting your wave counts on historical data can be an excellent way to hone your skills and build confidence. A very important point is to not cut corners. If you start skipping corrections because it is hard to pick out, then you will sacrifice the precision. You may be missing valuable information that means your count is illegal. The point of the theory is to explain the market psychology based on previously identified patterns, so there's no point in skipping. You may as well be looking at another chart or just guessing. In conclusion, while Elliott wave theory can be complex and challenging, it offers a powerful framework for understanding market movements and forecasting future price action. By mastering the rules, guidelines, and tools we've discussed, and by practicing regularly, you can significantly enhance your trading skills and improve your market analysis. That wraps up our first deep dive into the impulse wave and the foundational principles of Elliott wave theory. In the next videos, we will delve into more advanced topics such as corrective wave patterns, complex wave structures, and real-world applications of Elliott wave theory in trading various markets. Thank you for listening. Lots more to come.